Hey everyone, welcome to another episode of the Crypto Setups podcast. It has been a while, and today I have with me Eric. Eric, how are you today?
Doing great, Fez. Thanks for having me on, bro.
No worries, man. Look, Eric, why don't you introduce yourself, protocol, chain, like give everyone the spiel. What are we here to talk about?
Yeah, my name's Eric Weisenin. I'm usually known around here as the tokenomics guy. I'm a co-founder of AstroVault, a very new way of building out AMMs or DeFi in general. And we're built right now, first MVP live on Archway, the Archway protocol. So I separately designed the tokenomics for Archway, so I was on their team for a while as well. But AstroVault's my baby that I've been building out forever, and then I also dabble in the space as a tokenomics consultant.
Cool. Okay. So we're here to talk about AstroVault, but I'm going to pick your brain about Archway. Like why not? I've had TJ on; he's explained it a little bit. So, can you share a little bit about the Archway blockchain and what sets it apart from the other Cosmos chains out there?
Yeah. So Griffin, founder CEO, brilliant dude. He had this vision of like, look what's going on with Ethereum. All of the applications on top of it are driving value to Ethereum. You see this like fat protocol thesis. However, there's no real reason to build on Ethereum other than like the users, but it's really, really expensive and you don't get any of the money of it. Uniswap burns $23.1 million worth of ETH in a month and Unitoken holders are nothing. Like that's a problem,
Mm.
which is also what I'm solving just from a different direction. But then this protocol now would give part of the gas fees to the users, but also part of the gas fees would get burned, kind of like EIP 1559, but like a type of hybrid, really. And what
Mhm.
I love from it is, like, from my perspective, I'm focused on monetization of DeFi. I'm sick and tired of protocols just building out, throwing a token on it, and acting like they have a business model when they fundamentally don't. And so you see a lot of these protocols is like, oh, well, the L1 token has to do well, or else everything will fail, as
Yeah.
as if you can just build upon this axiom that everything won't fail. And if you don't capture value with a layer one token at all, like how can you trust it to be secure? If I'm building an application and I'm renting security from the layer one itself, and the layer one doesn't actually capitalize on any of the rent that I'm paying, then they're not going to be very secure. At some point, they're going to lose money. It's still expensive to own and operate a blockchain. And if you don't have that monetization built in, then you're kind of screwed. So it's a really nice hybrid that, in my opinion, has a really good chance to succeed.
Cool. Okay, that's a good summary of it. Okay, so I want to dive into Astrovault, but I feel like this is actually our first time chatting as well. So I want to get to know you. How did you start your journey? And so you're a tokenomics expert. How did that come about? How did you start your journey in crypto?
So I studied economic philosophy in
Okay.
college. Not much to do with it at the time, so I got into casinos. I started dealing cards, made ends meet. I found some issues with some games that came out. I've always really been into game theory. It's why I got in the casino industry in general. And so I found some games that were gonna be launched with huge mathematical problems. I just went to the break room, like, hey, this is what's going on. You're like, how do you know all this kind of stuff? Like, we have mathematicians that work on this. I'm like, no, you don't. Like, they're completely lost. Like, I really do this. Push it live for like 2 days, lost over $250,000, hired me to start doing all the game auditing and game design. So I ended up leading a think tank, got a bunch of changes and optimizations, and especially throughout California and the West Coast, throughout a lot of the casinos out there. And meanwhile, my side hustle was card counting. I ended up getting banned from all casinos for that. I'm still able to do it for work, but limited to where. And I was like, I need a new side hustle, man. Like, casinos are like fun, but need to do something, right? So
Yeah.
one of my coworkers was like, hey, check out this crypto stuff. This is like beginning of 2017. Like, this is fascinating, but what is this? I dove down the rabbit hole and like, this is really cool. I don't think Bitcoin really makes sense as money, but neither does the dollar. Um, Whatever's going on with smart contracts, but Ethereum's claiming that they can do. Like, I love Excel spreadsheets. Like, you're telling me that we can all own an Excel spreadsheet and we can share ownership of it, like as a new type of internet. I'm gonna check it out. Uniswap comes out, and I'm like, okay, this is cool, but this doesn't make any sense. You're seeing all these tokens pump, and there's no revenue, and there's all these business models that don't have revenue. And I'm like, I, I'll farm. Like, oh, if I can get 400% here and not have exposure to the rewards token and dump it, cool. I'll go do that.
Mm.
Oh, this one has like, lots of people are really focused on passing security audits and not tokenomics audits. There are a lot of things where the infrastructure, like what they built, their code does exactly what they want it to, and what they want it to do doesn't make sense. And so I just kind of went around and exploited things, found things here and there. But my issue was I really wanted it to succeed. Like I believe in DeFi. I believe in the ethos of of agency over your finances. You don't have to be rich enough to lose your own money, and if you're too poor, you have to pay somebody else to lose your money. It's ridiculous. And so I want to build DeFi better. I mean, the day we're recording this right now, like Hayden Adams from Uniswap just came out and they're like, hey, we're throwing a 0.15% trade fee on everything. By the way, that doesn't go to the token. That still earns no revenue. That just goes straight to our team. So we have a token worth $4.5 billion that has no revenue, but now our team's getting this. Like that is the state of DeFi right now. It's science fair projects that we act like our businesses.
Yep. Okay. That's fair. That's right. Okay. So AstroVault enters the picture. So it's not just another AMM. What sets AstroVault apart from everything else that's out there at the moment?
So I mentioned that like Uniswap, basically they're like, hey, let's take Coinbase. It's 2017, 2018. Like Hayden Adams is like, okay, Vitalik just said that it's possible to make something like this on chain. I read like Nakamoto's white paper. I want to bypass any major third parties. I want to be able to do this true P2P system. So we need to take what exists as Coinbase and put it on chain. Well, why would somebody put up Bitcoin and Ethereum to trade between? Well, we'll take the revenue, these trading fees that's going to the Coinbase team, we'll give it to the liquidity providers. It worked. Yay. Everyone's all happy, hunky dory. But then they're like, wait, okay. So we just gave all of the revenue that was going to Coinbase to them. Now we don't have any revenue. Let's launch a token. And that's what's been replicated over and over again. Well, one, that's not good enough. But two, that's not all the revenue that Coinbase is earning anymore. Coinbase charges less for listings of proof of stake tokens. Coinbase has an entire team focused on integrating and hosting the infrastructure for proof of stake ecosystems. They have like $7 billion worth of ETH from staking rewards. Like one of their primary business models is using the liquidity that is on their exchange, and all they actually have to do is keep enough tokens of each kind liquid enough to process withdrawals.
Yeah.
That is what AstroVault is creating in DeFi. So now we're earning the staking rewards underlying the liquidity. We're earning the trade fees. So like our token holders are earning all of this types of revenue, as opposed to like Uniswap, where there's only one type of revenue and none of it's going to the token because the team doesn't actually get it. And now as we use our token as a farm token, it justifies its value. So it's no longer like, oh, well, it can go to zero and everything goes like if it went to zero, the codified buyback and burn pressure would buy back and burn infinite tokens. That's impossible. If it went to such a low price, at some point you could stake AXV to earn Atom at a higher APR than you could stake Atom to earn Atom, but without a 21-day unbonding period and with more Atom governance power than you would have with the equivalent amount of money in Atom tokens. Like our fundamental floors are different. And so even if you think that like, oh, well, AMMs can turn it around in the future and you just want to compare us to like an AMM you're familiar with, we'll be like, well, what if like, say another AMM argues like, what if Osmosis? Like, what if Osmosis was also earning $3 or $4 million a year in Atom? Would you like it more? Yes. Well, that's what we do.
Okay. So, Eric, you talk AstroVault every day, right? So, and this is something I've realized as well from being in the space. Once you deal with something every day, it becomes far easier, and stuff you say, it's like, yeah, this just makes sense. But to the listener out there, if it's the first time taking it in, that was a lot of information. So I want to step it back and just talk through a couple of things. So the AstroVault at the moment is set up to capture, like if you take proof of stake assets, essentially, we know that these assets, if you hold them, if you're a holder, you can stake it and you earn interest yield in the native token. Your AstroVault kind of takes this concept, what traditional exchanges do when they have bags and bags of these tokens, they stake it and they offer, they actually offer, you can go on Binance, Coinbase and things like that and stake and you earn this amount of yield. And all they're doing is they're not doing a Celsius. They're not taking your money and going and degen farming. No, they're just natively staking it on behalf of you and passing on and keeping some profits for themselves. And that's how they're generating revenue. So you've taken this concept and gone, yeah, we can replicate this and make it better in DeFi where it's not central custody and all that stuff. And that's essentially what AstroVault specializes in, right? So it takes these assets and how does it, so let's break down now, how does that work? So does a user just go and Do they leave it, stake it on the side? Do they deposit in the LPs? What actually happens? Walk me through the process so people um,
Yeah.
understand the concept.
So we put the burden of dealing with this on the liquidity providers. If you want to come and you want to earn a high APR liquidity providing, you have to figure out how to do this, but we make it as easy as possible. You go on the trade page, and if you want to trade Atom for xAtom, which is our app specific derivative,
Mhm.
then you can just trade it, and it will either purchase xAtom or mint xAtom, whatever's best for you. You don't have to deal with
Okay.
any of that. But now you're going to go and you're going to trade for xAtom and say xArch. And instead of liquidity providing Atom and Arch directly, you'll liquidity provide xAtom and xArch, meaning that, say, we get $1 million in liquidity, that represents $500,000 worth of Arch that's staked and $500,000 worth of Atom that's staked, the rewards going to our treasury.
Yeah.
Now, where those rewards go in our treasury is protocol earned liquidity. We think this is going to be a huge buzzword, buzz phrase in the next bull market, where now we also have a pool of Atom to xAtom. We also have a pool of Arch to xArch. And all of
Mhm.
the native Arch staking rewards and the native Atom staking rewards are going as native Arch and native Atom in those pools. So we're not trading to xAtom. We're just constantly getting more and more of the native asset with which to process withdrawals.
Okay. So we've got. I'll just stick with Arch. So we've got Arch, and you have both sides. And X Arch is the state representation of Arch, correct?
Mhm.
So, and then what you just said there is then the X Arch is obviously earning Archway tokens as staking rewards, and that staking rewards sits in the treasury for AstroVault.
Yes.
Yeah, and okay, and then you mentioned about how does it top up the pool? What happens there? I lost you at the last part.
Yeah. So every couple hours, we'll
Yeah.
claim the staking rewards. On Arch, it's already on the same chain, but say it's Atom, it's on a different chain. We'll IBC it back across,
Mhm.
um, and then we'll put it in like a bulk distributor. 20% will go to AXV stakers, 80% will be immediately deployed in the Atom X Atom liquidity pool.
Okay. So yeah, it redistributes.
Yeah.
And with that, the question I have there as well, with the Arch and X Arch, or Atom, is it one for one? How's that exact pairing work? So
Yes. Thank you for taking the time to go through my white paper, by the way. Listeners, if you get a chance, astrovault.io/white paper if you're really in for a heck of a read. But we go through all of the math of what's currently being pursued. If you're
yeah,
familiar with the Cosmos ecosystem, you know something like Stride or Quicksilver,
yeah.
and they have what's called auto compounding derivatives, where the token is constantly rebasing against the
Mm,
underlying asset. If you hold ST Atom over time, that ST Atom is going to be worth more than Atom because it claims rewards and it mints itself, but you're not minting new ST Atom as that happens. Um, Now the issue with this is people just assume that it's going to maintain its peg because arbitrage, and they like that. People have just accepted that arbitrage without ever actually understanding what takes place to do that arbitrage, how expensive it is, um, and like fundamentally it's not arbitrage. So we created the term dilatory arbitrage to explain, because arbitrage doesn't work 21 to 24 days later.
mm.
Arbitrage is doing things at the same time by definition. But in addition to costing fees and worrying about the price in 3 weeks, you also have to worry about the opportunity cost. The minimum opportunity cost being like, what if I just staked Atom over the next 3 weeks where I could
Mm.
earn 1.1%? So why would I go and purchase this asset if it gets underneath Atom to purchase it and unmint it rather than just staking the asset myself? And you won't do it until it's several percent underneath the underlying asset. And this is a huge problem. And we've seen it. Like Stride just rate limited ST Atom. They just said, hey, you can't mint it anymore. Like, we're screwed. It's depegged 10% at one point. And if you're doing something like using a money market, if you're like taking out a loan or you're using Nolus or Levana, then you can get liquidated. You're on Umi. You can get liquidated because your collateral is an ST Atom, even if the price of Atom doesn't go down.
Mm.
So, like, fundamentally, this does not make sense to build an ecosystem on top of. So, yes, our derivatives can and always will trade exactly one for one. In fact, our pools that we use for it are constant sum market makers. They do force the trade at 1 to 1.
Mm,
Obviously, it still makes sense to have some kind of premium on liquidity, even if we have native assets coming in. What if it's not fast enough? What happens if in Coinbase people try to withdraw more Atom than they have available, which has happened?
mm,
Then they just kind of freeze withdrawals for a while and be like, oh, we're under maintenance. And what we do is like, hey, you can always, like, we have exponential trading fees. So at some point, it would be too expensive. Now, argument
mm.
is that's hardly ever going to happen. And the longer down the road we are, eventually that will never happen. But if and when it does happen, you can always unmint it and wait 21 to 24 days. I mean, that's what you have to do everywhere else. You still have that option.
Mm,
Arguments you're usually never going to have to.
mm. Okay, okay, this is pretty cool because what you said is in the derivative when it's staked, 80% because you mentioned earlier, 20% goes to the token holders. We'll come back to that. I want to know more about the token because there's a few questions there. But the 80% is essentially basically protocol owned liquidity, right? Because it's rewards that the protocol takes, but then puts back into the LPs, which, as we know, the more in the LP, the better it can accommodate trading, which generates more fees in turn, making the protocol more profitable. And who's benefiting from that? Token
So,
holders. And
yes, we don't care as much about volume as everyone else does. We're going to get that. Our whole ethos is like we're going to be a liquidity hub. And
yeah,
then eventually, because we're the liquidity hub, we'll get the volume. But everyone else is super focused or even on concentrated liquidity, which we have the most efficient of, by the way. But the reason they're focused on concentrated liquidity is because they're realizing, oh, real yield is what we can extract from fees
mm,
divided by liquidity, ignoring that, like, that's only if you have to take care of liquidity providers. What about a team? What about stakers or node operators if you're a chain yourself? Like, there are so many other baskets of tranches of people that need incentivization. And what we're saying is we earn revenue from the liquidity directly. So ignoring trade fees,
yeah.
as we get more Atom staking rewards coming in, which turns into more liquidity, that turns into more Atom staking rewards coming in, which turns into more liquidity. It's a whole snowball effect.
It's kind of both ways.
Yeah,
It's liquidity and yeah, volume will come, but you don't care because at the
yeah.
end of the day, this is happening.
And so volume's great. It's buyback pressure on our token. We get a
Yeah,
ton of volume, then sweet, a bunch of our tokens being bought back and burned.
yeah.
If we don't, then we don't have the codified volume, but it's specifically the liquidity that's building on top of itself.
Cool. Okay, so AstroVault then is really after those proof of stake assets, or what about stables and things like that?
Yeah. So a byproduct of what we built, um, like I said earlier, we need to be able to have enough of the tokens liquid to process withdrawals. That's what Coinbase
Yeah.
does. That's what we need to do. That's not easy. There's actually a
Mm,
lot of moving parts that need to go into making this work. But part of what we did in order to make this work ended up making for fantastic stable pools. Now, if we're dealing with stables, sure, we do not earn revenue from that liquidity.
yeah.
But no AMMs are earning revenue from their liquidity right now, anyways. We don't have to earn revenue from every pool. My background's in casinos. The way casinos run their business is they take a loss on basically every business that they offer.
Mm,
Their valet, their hotels, their even their poker rooms, usually all of their restaurants. They literally every part of their business operates at a loss except for their slot machines and their table games. But by offering all these other services, it brings so many more people into what makes them so much money.
mm,
Even if we take a loss and we're over incentivizing beyond what we earn in stable pools, even if we over incentivize beyond what we're earning in Bitcoin and Ethereum based pairs, um, that will enable users to have us be a one stop shop.
mm.
And by doing that, use the pools that we make a profit on. Right now, what you're seeing in other ecosystems is that they're operating every single pool at a loss because they don't earn revenue from their liquidity. We have an actual business. So it's
Mm.
yeah, it's give or take. We'll be doing a lot of yeah, a lot of balancing, a lot of public forum and DAO discussions on this. I'm training AI models to learn from things to try to make things as efficient and rebasing as efficient as possible of our rewards because it won't be directly proportionate, but it will be correlated with giving incentives to different pools based on how much we're earning from them. So if we're earning a lot
Okay.
in liquidity and there's a lot in trade fees in this pool, then it makes sense for us to give more tokens to that pool and incentives. But it won't be exact.
Okay. Okay. So since we've touched on incentives, and what kind of incentives are there at the moment
Yeah, right now
for the
there aren't
pools?
any. Right
Okay.
Our model is very different. Everyone's like, "Oh, we're a new AMM, but we're different." Sure, we forked 90% of that one, but we do transactions half a second faster, or some gimmick that's a little bit different. We're actually really different. The
Mm,
entire operations of our protocol is fundamentally different. Our concentrated liquidity is more efficient and fundamentally different than what you're going to experience with like a Uniswap v3. Our obviously our LP positions are fundamentally different. No part of our DEX is forked. It's all been built from the ground up.
mm,
Like, and yeah, in doing so, a lot of people just kind of said, "Oh, you're crazy. Oh, Uniswap has a valuation of $4.5 billion. What do you mean they don't make revenue?" I'm like, I know that you assume because they're valued really high right now that it means they're great. What was SafeMoon brilliant? Like,
mm.
I don't know what to tell you. Like, oh, well, it's not safe. It's not a Ponzi. Like, it has governance power. Does it govern the money on it? No. It doesn't even earn the fee they just threw on it. Like, what I'm saying is not very kind to a lot of the not the casino, a lot of the crypto industry. That
Mhm.
being said, I believe that the future is going to come from this space. The future won't include everybody. I want to make sure that we're in on it. So
Yeah.
we launched a proof of concept, we launched an MVP, and we put no incentives out. We just told other teams that instead of us giving incentives right now, why don't we just save you a bunch of money? Hey,
Mm.
you're paying $16,200 a month right now to incentivize your pool on Osmosis, where they're matching your incentives with like $1,500, and we can see that like in order to maintain liquidity positions, $7,000 a month of your tokens being sold. Well, let's just get liquidity for us here and don't pay anything out of pocket. And let's nullify that selling pressure. In fact, we're going to raise your bonded rate, lower your inflation, and then also lower sales that are coming from your other validators and stakers because their APR is going down. We're not nickeling and diming our user base. We're actually hosting the infrastructure of the interchain and securing the networks with our liquidity, and therefore lowering the staking rewards of people not using our protocol. We're not
Yeah.
creating new money.
So that the logic there is because, as you know, the more you stake, the rewards, the rate drops because the yield gets distributed. So if your pool has a ton of liquidity, if you have like 20 million, 30 million, well, you're sucking up a lot of those rewards, which is rewards that isn't then getting sold in the market. That's the logic around. Yeah. Okay.
Yeah.
Totally. Light
And
bulb.
so pre-incentives, our token's not yet live. We're actually going to give an airdrop to our early LPs, but we wanted to prove this before our token's live.
Mhm.
We've already earned over $31,000 at this time in protocol earned liquidity. So like close to 3% of all of our liquidity is protocol owned. We've done no
Yeah.
bonds. We've done no incentives. Like that's just what our protocol's earned. If we didn't have
Yeah.
this model, we just have that much less liquidity. We've also earned like, I don't know, I think $6,000-7,000 towards buying back and burning our token. We don't have a
Yeah.
token. Like that's just sitting there waiting to buy back our token.
Yeah.
And meanwhile, you can see other things in the ecosystem that like at their success at the bull market, they got to $1.6 billion in liquidity. They got to $3 billion in monthly volume, and they earned no atom. They
Mm.
had no buybacks. They didn't earn anything with which to do that. And so now as everything's gone way down, it's like, what are you hoping you get back to those previous highs that you got nothing from?
Mm.
Like it, yeah.
Yeah. No, no, I see it. I see it. Very passionate, Eric. I love it. Okay, okay. So we've got the token. We've talked about this. So there's no token, but there is a token. Let's, because I've seen on the site, like when I sign, it's got a grav. There's something there telling me. So I've gotten confused there. Now, I was curious about that. Okay, so what is that? And about this token you mentioned, is there going to be a dual tokenomics? Give me a bit of a overview around the actual token for the protocol.
Yeah. So what you're referring to is Gravitate, and that is a
Yes.
token that's live. You just can't really do anything with it, and that's by design. It might seem like dual tokenomics. Our only token, governance token, tradable token will be AXV, which we will launch.
Okay.
Gravitate is a dynamic claim function. Basically, we want to incentivize traders on our platform. Part
Hmm.
of the way crypto works more efficiently than other businesses and why businesses will go to crypto is you can very easily, through emissions, incentivize what makes you money. And
Hmm.
we make money from liquidity providers and from traders. So we're not just going to give emissions to liquidity providers, we're also going to give emissions to traders. But that's not easy to do because we don't know how many people are going to trade. You can make it like, oh, well, just immediately like When they trade this much, we mint this many tokens. Now
Mm.
that's gameable. We don't like print on demand tokenomics. Or it could be like, oh, well, they just build up, and every time somebody makes a trade, well, now somebody traded $1 and made $10, and the next person traded $10,000 and made nothing. So what Gravitate does is Gravitate, this separate token that you cannot send to anybody, you cannot sell, you cannot trade, will mint on demand based on the volume you're putting in trading. So every couple hours, we're rebasing like how much Gravitate will be printed based on the different tokens' prices. And then as you trade, you mint Gravitate, but a set percentage of our inflation will be going to this Gravitate pool. And then at any time, you can burn your Gravitate for your percentage of the AXV underneath it. So the less people are trading, the more valuable it actually is. The more people
Mm.
are trading, the less we really need to incentivize it as well.
Okay. Okay, cool. So that explains that token, and let's talk about the protocol token. So how you mentioned it's not been distributed. Is there a total supply? How is all that going to work?
Yeah. There will be a max supply sometime, someday. We're not going to force it.
Okay.
I'm in general not a fan of max supplies, third names, halvings, what have you, where you basically force a like survive by date or you're screwed. Like the ability for monetaristic inflation, the ability for us to print tokens, to print currency here is what makes crypto better than real business. And even in real business, you have like inflation every time you do a new round. You print new stock, and then you like have to figure out what happens to all the previous stuff. We just make that so much more dynamic here. So AstroVault will be counter-inflationary, where there is this kind of perpetual emissions at a flat rate. So many tokens are minted per year, as well as there's counter-inflation. Whatever is being earned by the protocol. So as our liquidity position is earning AXV rewards, those are automatically burned. All the trade fees on the standard pools are buying back and burning our token. So as our liquidity position grows, the inflation kind of gets lower, but additionally, we can just eventually turn it off. Um, and the way, and so it's a fixed emission. It's not like based on percent of
Mm.
supply. It will just be so many tokens per year. And then it should like not only as a net supply increases, have the inflation percentage technically be going down, but also the overall like net emitted tokens will go down as the burn rate gets higher.
Yeah.
Now, what happens in eventuality is right now we have AMMs that most come out with a max supply because that's what people are accustomed to, which we need to move on past. And what happens when they hit the max supply? Like, oh, the team
Mm.
doesn't get new tokens. Oh, we don't incentivize liquidity. We don't actually own any. So now all the liquidity just leaves. The team has nothing, and we all just move on to another AMM. We've seen it a million times.
Mm.
We can actually turn off our emissions eventually. The DAO say chooses to, like say, oh, we've got 1 billion in POL, we don't really need it anymore. Let's just turn off emissions. It's like, oh, well, if you turn off emissions, APR goes to zero. Well, if APR goes to zero, everybody's going to take their liquidity away. Like, you're right. You're absolutely right. And that's the same problem with every other AMM. The difference is we've got $1 billion in POL. That's still
Yeah.
growing
You
on
own
top
it.
of itself. At this
Yeah.
point, with no emissions, our token's still perpetually deflationary because there's still buyback and burn pressure from all the
Mm.
trade fees. And our dividends that are going to our token stakers, because the 20% of staking rewards from the different layer ones go to our token stakers, are actually growing because our liquidity amount of those tokens is going up while the overall supply of our token is perpetually
Mm.
going down, and the governance power associated with it. So we do have an eventuality where we're not perpetually dependent on inflation. It's probably most efficient if the DAO chooses to leave some level of inflation on in perpetuity. But we just have to get to a point where people are less scared of counter-inflationary models.
Yeah.
Ethereum's counter-inflationary.
Yeah. 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 No, that makes sense. So, with the as a token holder, and I would stake once the distribution starts. I assume, would I be staking it? How, in terms of those fees, what I'm trying to understand is how do you get those fees? Do you still get the fees in like the X assets, or yeah, will it be you get it paid in Arch tokens, or will you get multiple tokens? Like, how will that work?
All of what you said. There will
Okay.
be there will be different staking pools. So we'll have a core staking pool that is the hub of our governance.
Yep.
That you will also get some AXV emissions in. And then if we get voluntary contributions, say a layer two or an app specific, like an app token, wants to list on us. Like we can list anything and everything, and we can charge for listings, just like Coinbase. We'll charge less if we're going to earn from the liquidity. But if they like, hey, we want boosted APR too, we want boosted above what your protocol is going to earn from us. Here, take some of our tokens, give them to your token holders, and give us boosted APR to incentivize liquidity. Like that's how
Mm.
deals are usually done on AMMs right now. We can do that kind of stuff too. And so you can stake AXV to earn AXV and a bunch of those tokens in one pool. And in that pool, you have governance power over our DAO as well as over all of the layer ones. In the other pools, it'll be just like stake AXV to earn Arch in this one, stake AXV to earn Atom in this one, and have a bunch of farms that way. And
Yeah.
the governance power of L1s will be distributed so that the core AXV staking DAO has governance power in all of them. The single farms will only have governance power in the represented one, and then
Mm.
as well as the AXV to L1 asset liquidity pool tokens will also have governance power of those L1s. So
Mm.
it's going to be an interesting, as far as governance powers go, governance tokens go. Our token governs way more than we've really seen in
Mm.
governance tokens so far yet.
Yeah, yeah. And I know I'm really asking a lot about the token. I'm just
Seriously.
actually very curious. So, and how far away is the token from launching? Even though at the moment, like it's so good that you managed to secure liquidity and show that proof of concept and things before a token's even out there. Because everything you've said, like, let's say hypothetically, you didn't do it for another year. The longer you wait, technically, and if you can acquire more liquidity, it kind of makes it a very successful launch of the protocol token because you'll have a ton of it already burning um, the token itself by the emissions. Because yeah, you see, my mind is spinning here. Okay, so how far away are we from the token?
We're ready to launch it right now.
Yeah.
We will be making an announcement pretty soon. We're in conversations. Just I'm a pretty open and honest guy. We're in conversations with other partners. We have fully self-funded to get ourselves where we are.
Yeah.
Um, But we just wanted to prove to everyone that we can, that it works, and didn't want to change our model for people who didn't understand it.
Mm.
But at this point, we want to grow. We, in our opinion, have shown that it works, that
Yeah.
it's great, and that it is the path forward. And we want to be able to grow and be the first really to market with this idea before other people copy us. And and in doing so, we're going to need more funding. And while we're talking to several partners, some of them would want us to go through a couple more things before we launch. And
Mm.
so if we choose to go with them, we'll have to probably delay it another 2 months. And if we don't, we'll probably just launch it immediately because we can.
Yeah.
We're ready for it.
No, it makes sense. Okay, cool. And there was one more question that slipped my mind. So, uh, I guess then the next question I have is around, because if you go to the website, I noticed you've made it quite easy for users across IBC to move assets in and out. So you don't need to go to a bridge, like the app allows you to, move assets from different Cosmos chains. Can you talk to that a little bit? I'm curious because I know just before we started the interview as well, you were talking about ensuring users who haven't got any Archway tokens can actually utilize the protocol as well. So I'm keen to get a bit of how all that works.
Yeah, thank you. A lot of people have asked us, like, oh, if your app's so good, why didn't you launch an app chain? And most of it's just because we're stubborn and wanted to prove a point that it doesn't make sense. So Archway is a perfectly good chain. They know how to
Mm.
run a chain. They're doing a great job at running a chain.
Yeah.
We're really good at building an app. We've done a great job of building an app. There's efficiency and specialization, and we're in this narrative where everyone should run a chain. And part of what I did in the Archway economic paper was go through a mock cost benefit analysis where I do really low estimates of numbers and come up with in this basically simulation that an application launching its own chain costs over $3 million a year,
Mm.
like as a really low estimation. We've seen app chains that you guys are well familiar with that have spent 12 or more $1 million a year, that are the smaller chains, and that's wild. Like
Mm.
that's so expensive, and the chain itself doesn't bring any more revenue. So we would rather just build out one as an app. We can build on an app on more chains if we want to. We can always scale up and build our own chain or join ICS at any time if we want to in the future. But what we lose out on having an application instead of an app chain is the functionality of one, having our governance token be the token for gas, but two, having all of the customizations that we desire. So there are a couple things we can't do in our UI just because we kind of DDoS things, and if we had more control of how to structure it, we'd be able to. But two, if we tell people to go to a competitor DEX to buy Arch so they have the opportunity to use AstroVault, that's ridiculous. So what we're doing
Mm.
right now is we enabled this fee grant from the fee grant module. We actually worked pretty closely with the Archway team and Leap on fixing the initial fee grant model. Nobody's really ever used it before because it's kind of like giving money away.
Yeah.
That being said, it's worth it to us. And with Archway, we kind of get that money back in the fee rebates anyways. So now you can come to AstroVault with Atom, with USDC, with ETH, and you can make that first trade on our gas. So you can buy Arch basically, and then you'll have Arch to cover gas for future trades. It's really restrictive in what you can do right now, and we have to kind of force it through the UI. We're actually working to help better that module so we can use it more and better in the future. But in general, we're going to make sure we do everything we can to make it as easy as possible to bring money in and to use our protocol. Use an online casino. The very first thing it's going to prompt you to do is like, hey, deposit funds. Hey, go play
Yeah.
this. Like, they're businesses. We're
Yeah.
running this like a business.
Yeah. No, cool. Okay, that makes sense. And one thing I didn't touch on, and I'm very curious, is because as you mentioned, Archway is unique, and the way it rewards uh, DApps, contract and inflations and things like that. How does Astrovault utilize that? So, yeah.
Yeah, that's a great question. If you guys are new to Archway, the chain that we're built on, their focus is being the value capture chain, where again they're relaying like as your application gets used, and you can even set paywalls on it. But basically, you're going to earn money as a developer from people are using your product. And I haven't talked at all about their developer rewards. Um, we aren't dependent on that, but it's a pretty cool bonus.
Mhm.
So our team has made an extra grand or so over the last 2-3 months. Right now, like the token price isn't as good as when it launched, and we haven't had as many daily active users. So as usage grows, um, it will do better. They just finally enacted the burn, so now half of gas is burned. And basically, if we get more applications to all come and build together on Archway, it drives demand for the gas and actually burns more and more and more of the token, raising the value of the rewards that everybody's earning. So it's kind of up to us on BizDev to like get more people to come and be a nice knit family. And if so, then we all grow together as a community. But yeah, if we built on a different chain, we just wouldn't have that. But that's
Mm.
going straight to the team. We're not like, our model's not predicated on that.
Okay, cool, cool. Okay, I think this has been quite a good overview of the protocol. Have we missed anything, Eric, that you want to talk about?
Oh man.
Just a
I don't think
self compliment there, Oh, we've covered everything. Yeah.
there's always so much more to talk about, man. We have
Yeah.
a B2B NFT protocol that we're building out right now. Like
Okay.
AstroVault, we already have everything built out where we can partner with any NFT project for any duration of time to
Yeah.
earn boosted APR. Where now we boost secondary sales, or like, oh, we're gonna list your token. What's your favorite NFT project? Okay, cool. We'll partner with them for a month.
Ah,
If you want
that's
to re up
cool.
for another month, like put us in the royalties. Something like
Yeah.
that. Just anything we can do to generate more revenue for the product to make the user experience more sticky and to just
Yeah.
make it fun. There's so much cool stuff to do that people just haven't done.
Yeah,
And
yeah, yeah.
we're
And
just we're
that's a
out
cool
here
way to
building.
do promos in communities as well, because NFTs have managed to establish, their cultish communities in a good way. I say that. So yeah, you can tap into that audience. What a great way! That's pretty cool. So have you said that's pretty much done? And is it just are you waiting for first partner to come along to utilize it to launch it?
Yeah, so we will be our own first partner. We'll do our own NFT set called
Yeah.
Quantum Club that will have basically perpetual boosted APR, as well as special governance perks,
Mhm.
just to showcase that we can do all of this, and then we can also do it for other people as well. But we also do have our first brick and mortar real business that will be using us for a loyalty program, in a really cool thing that we built. So we're not sure when we'll fully announce that, but that should be a nice little teaser. Obviously, we need the token to go live to boost any APR.
Yeah. You're giving me half
we have
alphas here.
a lot of it built out already.
Okay, cool. This brick and mortar business, I want to ask more, but I feel like you're not going to give me any more on that topic. Okay. So there's that. Anything else? I don't know what else to ask.
One more thing, I guess, is
Mm,
we are the first to do this
yeah.
for monetizing our DeFi protocol and earning revenue from the liquidity that we attract. It's not good enough for us to be like, hey, we did it for AMMs, we're good, go AstroVault.
Mm,
We have to do this for everybody. And so we're actually working on making what we did into an SDK so that every money market, every lending protocol cannot well, why would people use X atom outside of AstroVault? They wouldn't. I want Nolus to make N atom, and I want them to use their own derivative as collateral so that now they're earning revenue from the TVL that they attract and have liquidity no longer be a vanity metric. The issue is every protocol that does this needs to have enough of the native asset by which to be able to liquidate, and they're not going to be able to. They're not going to be a liquidity hub the way that AstroVault is.
mhm,
So we're going to build it out so that they can use their own derivative, but then they can use the IP that we have for our stable pools, where we give them access to our derivative, which has access to the negative asset liquidity. So now we can make all of the app chains, all of the applications around us also a lot more profitable while they tie back into AstroVault. And we just build a kind of growing ecosystem. We're not trying to do everything ourselves. There's efficiency
mm,
and specialization. We want to be the best. We want to be the best AMM. We want to help all of our clients with infrastructure, marketing, biz dev, and product market fit, and anything else we can possibly do. We want to integrate all of our customers as well as we can.
yeah.
But in doing so, we're very much aimed to grow the pie and just kind of be the base layer. So that's kind of how this new narrative intends to scale.
Yeah. Cool. And I guess I should have asked this earlier, but a bit late, but I'm still going to ask it. So I guess when you talk about when a user thinks, okay, if I supply liquidity, I'm going to lose out on my staking rewards because that's a big barrier, right? So in your case, I do understand like so they'd be incentivized via the protocol token, but there's still the barrier of 80% off it. So how would you switch people's mentality or make them understand that what you're giving up now or the percentage you're giving up you're going to make back in this way. Could you talk through that a little bit?
Yeah, our argument isn't really that you're going to give anything up. It's up to
Yeah.
you to kind of make your best decision. Some comparable or like some alternative options right now is say you can not earn yield or earn very little emissions of a token to liquidity provide with like two stride based assets. Now, those two assets are perpetually going to depeg. So, whenever you want to leave your position, you have to wait 21 to 24 days, which you don't have any lockup on AstroVault. But additionally, you only get like the trade fees, which aren't all that much. So it's not like it's clunky, and it's still not really building towards the future. What happens if you just can't unmint stride just because stuff's going on?
Mhm.
So another alternative would be like, oh, you are doing a concentrated liquidity pool of like just regular assets like Atom and Arch, and you just lost any potential LP incentives you would have gotten on osmosis through Prop 638. And in doing so, you are hoping that the trade fees that you earn are more than the staking rewards. And that's ridiculous. You're putting on way more risk in order to probably earn a lot less money. And what we're seeing from that is liquidity just absolutely leaving the ecosystem.
Mm,
So, what we're expecting is that since we have a baseline of protocol earned liquidity of like money we're making from the liquidity, and above that baseline is the money that we're earning from trade fees, it will most likely end up being that the APRs of liquidity providing in our pools are higher than that of staking, probably noticeably, as it's kind of
mm,
like a futures index token of the Cosmos and further ecosystems. So yeah, our basically thing is no lockup, earn higher APR, and yes, you do take on impermanent loss risk, but you don't have the lockup. And yeah,
mm. Okay, yeah, no, it's very cool. I do love the innovation here. Like, it is different to every other AMM. In general, it is using the core native asset of the respective chains in a very good way. Uh, Yeah, look, Eric, that's all I have. I think we've covered it, everything in detail. I will be separately making a tutorial, just walking through as I do on the Crypto Setups channel. Yeah, so I was keen to have this because I had so many of these questions, and it's good to have answers. And now I feel like I'll be able to make better content. Thanks for this interview. So really appreciate you coming on the show, Eric.
Fez, thank you so much for having me. And if you're up for one more paper, we did just drop our time flex paper for our third pool type, general purpose concentrated liquidity for predictably priced assets or established price assets, where you will be able to trade Bitcoin and Ethereum more efficiently on AstroVault than you can on Coinbase. So.
Okay. Well, yes, I want to know more. Can you tell me more?
AstroVault.io/white paper/TF for the time flex paper. It's not quite as pretty as the white paper, but it goes through a couple demos for it. We have them denoted as hybrid pools on our UI right now. So we have two, and that's basically what we're doing for our derivative, two auto compounding derivatives. We don't have Stride yet, but right now we have S-Arch and AMP-Arch pools. And this is how these other assets will key into our ecosystem, where then everything will route between the xAssets.
Okay. Yeah, I think I need to read it and wrap my head around it. Okay, cool.
Fez, thank you so much for having me, bro.
No, thank you, Eric. I really appreciate it. Everyone, like, share, subscribe, and stay tuned for the tutorial. Thanks, everyone.